Hey everyone, and welcome to The Explainer. Today, we're unpacking one of the most fascinating financial paradoxes in modern technology. We're looking at a tech giant that is literally printing mountains of cash while simultaneously spending historic, almost incomprehensible amounts of money on the future. The company is Meta, and their recent second quarter earnings report for 2026 revealed a massive contradiction that every investor and tech observer really needs to understand. Are they building the most valuable artificial intelligence business in the world? Or are they just spending way too much money just to stay in the race? Let's dive in.
To really wrap our heads around the scale of what's happening, we have to start with what Meta is actually doing right. In just the second quarter alone, they brought in a staggering $60.8 billion in revenue. It's a huge testament to the sheer power of their existing machine.
And get this, that massive revenue represents a 28% jump from the exact same period a year earlier. Now, for a company of Meta's enormous size, keep in mind they're already one of the largest tech companies on Earth, growing revenue by nearly 30% is absolutely extraordinary. It means their core business is firing on all cylinders. But then, you look at another number.
All right, prepare for some serious whiplash here, because in that exact same wildly successful quarter, Meta's free cash flow completely collapsed. It plummeted by roughly 91%, dropping from $8.55 billion down to just $784 million. So you have to ask yourself, how does a company grow revenue by 28% but see its free cash flow almost entirely vanish?
Well, the answer lies in a single, jaw-dropping figure. $145 billion. That is the upper end of what Meta actually plans to spend on capital expenditures in 2026 alone. To put that into perspective, that is more than the entire GDP of Morocco. It's a massive investment in AI, data centers, specialized chips, computing infrastructure, and the enormous physical machines behind the next generation of tech. Which brings us to our central question for today. Is this historic spending spree an act of genius or just a colossal risk?
Let's look at part one, the advertising engine funding the future. You see, Meta has spent years building this incredibly powerful four-step feedback loop. First, millions of users across platforms like Facebook and Instagram create data. Second, Meta uses its AI systems to process all that data and improve their content recommendations. Third, those better recommendations keep you, the user, highly engaged. And fourth, more engagement and better targeting naturally lead millions of businesses to spend way more on ads. And right now, that machine is working flawlessly.
Unlike a brand new startup trying to build an AI platform from scratch, Meta already has tens of billions of dollars flowing in every single quarter. As they pointed out themselves, AI can also make the existing Meta business more valuable. It doesn't necessarily need to become a completely separate, standalone trillion-dollar product for them to win here. Because if better predictions improve ad performance, well, advertisers are going to pay more. Basically, their massive ad revenue is effectively financing their own AI transition. Which leads us to part two. The gamble on infrastructure and margins.
Look, a 91% drop in free cash flow sounds terrifying, right? But it actually doesn't mean Meta is suddenly unprofitable or running out of cash. Free cash flow is heavily affected by capital expenditures. Meta is simply taking its mountains of cash and aggressively converting it into physical hardware. They are actively building the heavy infrastructure needed to run these advanced AI systems. But this aggressive spending definitely creates some immediate tension in their financial statements. Because while revenue grew at a really healthy 28%, Meta's costs and expenses skyrocketed by 55%. They are hiring, they're building massive data centers, and they're buying AI infrastructure at a rate that is vastly outpacing their immediate revenue growth.
And you know what happens when expenses grow twice as fast as revenue? Profitability gets squeezed. Meta's operating margins took a dramatic hit, contracting sharply from 43% down to 31%. What we're watching is the classic tension between short-term profitability and long-term investment playing out in real time.
And that brings us right back to the sheer scale of this outlook, a $130 billion to $145 billion capital expenditure plan for 2026. Guys, this isn't money being spent just to keep Instagram's servers humming along. This is Mark Zuckerberg buying hundreds of thousands of highly specialized AI chips that can cost upwards of 30 grand a pop. It's an aggressive, company-defining bet that AI is the absolute next major computing platform in human history. And if it is, Meta knows they simply cannot afford to be late to the party. Plus, Meta isn't doing this in a vacuum. The AI boom is an infrastructure story just as much as it's a software story. To even compete, AI companies like Meta have to buy advanced processors from chip companies like NVIDIA. Then, they have to build huge physical data centers to actually house those chips. And finally, they have to secure enormous amounts of electricity just to power and cool the whole shebang. Meta is sitting right at the center of this massive global economic cycle.
So, let's break down part 3. The bull versus bear case.
For the bulls, the folks who argue Meta is making brilliant strategic moves here, it all rests on their massive ecosystem advantage. Think about it. Any incredible AI startup still has to go out and fight for users. Meta already has billions of them. Imagine an incredibly advanced AI assistant that's instantly deployed inside WhatsApp, Instagram, Messenger, and even their Ray-Ban smart glasses. Meta can build AI products directly on top of an existing massive global ecosystem.
So while the bulls argue that Meta is simply investing ahead of massive future demand, the bear case starts with a very simple and honestly dangerous question. What if AI monetization doesn't arrive fast enough? $145 billion is a staggering amount of capital. If Meta spends aggressively for years, but the AI doesn't generate enough incremental revenue to cover all that spending, investors are absolutely going to lose their patience.
And the bears have another really strong argument to make: the competition. Meta is not running on an empty track here. They are competing directly against Google, Microsoft, Amazon, OpenAI, Anthropic, NVIDIA, literally some of the richest, most technologically advanced companies on Earth. And the infrastructure risk? It's huge. Technology changes so fast. The cutting-edge chips and servers Meta is spending billions on today could literally become obsolete tomorrow. It's a terrifying balancing act. Spend enough so you don't fall behind, but not so much that your financial returns completely collapse.
Which leads us nicely into our final section, the ultimate ROI question.
At the end of the day, the question isn't whether Meta is a good company. Their core business is phenomenally strong. We've seen the numbers. The real question we have to ask is, what return will Meta actually earn on the hundreds of billions of dollars they're committing to this physical infrastructure? Because there's a golden rule in the market. A fantastic company can still be an incredibly expensive stock if its massive investments fail to generate substantial future revenue. Ultimately, Meta doesn't just need to prove that artificial intelligence is exciting, they need to prove that it can make their shareholders richer. Mark Zuckerberg is betting the entire future of his company that this AI opportunity justifies spending extraordinary amounts of money today just to secure tomorrow. So, we're going to leave you with this. Is Meta's $145 billion bet a stroke of absolute visionary genius? Or could it be the most expensive miscalculation in tech history? Thank you so much for joining us for this explainer. Until next time.